Today, we're looking at an unusual deal that could yield an impressive 90% annual return. But the question is, why is the return so high on a simple takeover arbitrage deal? In the majority of takeover deals we look at on this channel, you could expect to earn a low-risk 5 or 6% rate of return. The operative words here are low risk. As the risk increases, so does the expected rate of return to compensate for the greater probability of loss. And so is the case today. We are looking at the proposed takeover of oil services company, Wood Group, by Dubai-based Share and Partners Holdings, known as Sidara. Sidara has tabled a bid of 35 pence per share for Wood Group, against a market price of 23 pence. This results in an expected return of 49%, or 90% on an annual basis. However, the risk-adjusted return is a rather more modest 12%. This significant difference between the expected and risk-adjusted return is because, in its current form, the bid is non-binding and conditional. This means Sidara could walk away from the deal at any time. As a quick recap of the history of this deal, Wood Group was founded in Scotland in 1982 by Iron Wood to provide services to the energy sector, particularly the burgeoning North Sea oil rigs. Alongside the booming oil business in the 1980s, the company grew rapidly, even taking over competitors, including Texas-based Mustang Engineering. Wood Group was listed on the London Stock Exchange in 2002 and continued its process of aggressive international expansion. This empire building worked very well at first, but, as is often the case, the company grew too quickly and into too many diverse business areas. Wood Group was forced to rationalize its business and sell non-core holdings after reporting a loss of more than $350 million in 2022. This turmoil within the company attracted the interest of private equity bidders, and in 2023, Apollo Global bid £1.4 billion to take the company private, the equivalent of 235 pence per share. The offer from Apollo was rejected by Wood as significantly undervaluing the business and its future prospects. Fast forward to February 2025, and Wood Group's chief financial officer, Arvind Balan, was forced to resign after it was revealed his professional qualifications had been fabricated. This news obviously resulted in a precipitous fall in the company's share price, and concerns were raised about the reliability of the accounts. And so now, in April 2025, we have a bid from Sidara of just 35 pence per share for Wood Group, very significantly less than the 235 pence bid by Apollo in 2023. The interesting thing this time is that the directors of Wood Group have stated, should Sidara make a formal bid of 35 pence per share, they are minded to recommend it to the shareholders. This despite it valuing the company at only £240 million, compared to £1.4 billion from Apollo in 2023. For their part, Sidara are progressing with their due diligence, no doubt scrutinizing the company accounts to see just how reliable they are before they decide whether to submit a formal bid, and if they do, at what price. So, there we have it. There is the potential for a very significant return for an investor brave enough to take a position in this deal, but the downside risk here is very substantial. So, what does everyone think of this deal? Let me know in the comments below, and don't forget to like and follow if you found the video useful. Be aware that all the figures mentioned are at the date of my calculations and will change in line with the share price, any changes to the deal terms, and the duration to close. As always, this information is provided for educational purposes only. You should not consider anything in this video to be investment or financial advice, nor a recommendation or endorsement to buy or sell any financial instrument. You should always conduct your own research before considering any investment and seek independent financial advice. Thank you for joining me today, and until next time, have a great day.